Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome back to Real Estate Investing Abundance. I'm your host, Dr. Alan, and I'm delighted to have you with us again today. And we are going to take a look today at holistic multifamily risk management best practices. And with us to enlighten us on this topic is Calvin Roberts. Calvin is the principal of Falcon Insurance Agency of Michigan, and he is an avid real estate risk management enthusiast. So, Calvin, take us into the show and share a moment from your formative years that helped you to be who you are today.
Awesome. Thank you again for having me, Alan. So a formative moment from my early years. As soon as you said that, I thought back to junior year of high school, conditioning / weightlifting class. My instructor was a former NFL Detroit Lions football player. I played with the Lions for 7 or 8 years during the 1980s, early 1990s. And to give you a little bit of context, at that age, I just didn't have the same tenacity and grit you see around you today. The motivation and hunger was there, but it just wasn't surface, I guess is how I'll phrase it. Mr. Rubik, he lit a fire under me. He never allowed me to just sit back on the weight bench playing on my phone. So kind of having that motivation, I guess we'll call it, smacked into me immediately was the formative moment that came to mind there.
Oh, well, that is interesting. A different way of coming about that is for sure. But it's always nice to find our way into a spirit and a passion of motivation, no matter how it gets to us there. Though I could think of probably better and more supportive ways, but whatever.
Well, I say it as it was all love coming from my teacher. It wasn't anger. It was purely he wanted to see us getting strong, working hard, coming to weight class and taking it seriously. So he just didn't take laziness for an answer. And for that, I am genuinely thankful.
Yeah. Well, let's get into insurance, Calvin. And I mean, first of all, just tell us what are the property and casualty trends that we in multifamily should be looking at for the near term and for the next few years.
So no good news, unfortunately, coming from me today on that front. I think we're in for a tumultuous 2024. I think it's going to be similarly unpleasant 2023. Not worse, not really predictably better or foreseeably better, but not any exciting positive, yay, we're at the light at the end of the tunnel. No, it's tumultuous for at least the short term, possibly short and medium term future. Kind of tough to say without looking into my crystal ball, but really the precipitating factors that have driven most of the premium variance that we've experienced over this past year, being driven by the diminished availability of capital in the reinsurance market. So essentially what that is, reinsurance is insurance for the insurance companies. They buy it so that if you're an insurance company who isn't a Berkshire Hathaway owned insurance company, you don't have to keep all of the risk on your balance sheet. It enables primary insurance companies to do more of what they're good at, which is underwriting, pricing, selecting risk. But essentially, think of it as almost a stop-loss mechanism for insurance companies, whereby purchasing reinsurance coverage from a generally larger reinsurance company, the AIGs, the Hanover RE, the Munich RE of the world, they're able to pass a good chunk of the risk off to someone else and get it away from their balance sheet. And that enables them, based on their reserves and liquidity requirements imposed on them by each state Department of Insurance, to write more policies than they would otherwise be able to. They can insure more properties, more businesses. But that's really what's driven the unpleasantries that we found in property and casualty insurance over this past year. So essentially, we were in a very favorable seller's reinsurance market for the better part of 11, 12 years leading up to early 2022. That was caused primarily by the low interest rate environment that we had found ourselves in during that time. And, there was a surplus of investment capital in the economy. There was cheap money, easy money available everywhere. As interest rates have climbed back closer to historical trends or averages, you're seeing a diminished availability of investment capital in most markets. I mean, look at multifamily. There's less buying pressure. Hopefully, in theory, that'll lead to asset valuations coming down at least a little bit so that new acquisitions can start to make sense again. But because there is a insufficient amount of capital in reinsurance markets as of late 2023, it is now a very hostile seller's market for reinsurance. Primary insurers, your Travelers, your State Farm, Nationwide, those companies are being asked to cede or pay more of the premium that they collect. That's how reinsurance companies get paid, is a percentage of the total gross premium that's collected. But they're being asked to cede more of that premium and receive less coverage in return. And as of that, or as a result of that, it's essentially breaking the pricing model for primary insurance companies. They can't figure out how to underwrite profitably when instead of ceding 15% and capping their exposure at, let's say, $2.5 million per account, maybe now they're being asked to cede 23%, and they're only able to cap their exposure at 2.5 million in losses per account. So it's essentially primary insurance companies passing on the increased cost of reinsurance to the end consumer. And I don't think their reinsurance markets are really letting up on the gas, at least for now. We're heading into a pretty rough 2024. I was reading an article maybe a month ago now, but over 100 mutual insurance companies met in upstate New York, and most of them, 80% of them, still had not obtained their reinsurance coverage for the January 1st treaty expiration. Most reinsurance treaties renew on January 1st and July 1st each year. So it's bad. I mean, that's why, for example, you saw Nationwide get out of multifamily on June 30th. July 1st is when their reinsurance expired, and they likely couldn't obtain sufficient reinsurance capacity at a price point that made sense for them. So they just said, screw this, we're done. We'll take another look once conditions improve in the market. But until then, we're out. So yeah, no good news.
Well, is there any reasonable way for those of us in multifamily operations to insulate ourselves from essentially this marketplace dysphoria?
So yes and no. It's a complicated question with really no easy answer, unfortunately. It's proactive and a little bit of retrospective in the ways that we're able to insulate ourselves from marketplace trends and calamity. So let's say you have a 300-unit apartment complex in Ohio, and it's written with Greater New York Mutual, a super regional insurance company, an admitted insurance company based in upstate New York. They write in 14 states, and one of their core practices is multifamily insurance. They write a boatload of apartments. I always recommend to our multifamily operators and property management company insured that, one, you need to be requiring renters insurance to be purchased by all of your tenants every time, every year. Mm-hmm. And two, if they fail to do that, you need to be force placing that coverage on their behalf at their expense with an equivalent product form that protects your interest as the property owner or operator. And the reason I suggest this isn't because we're necessarily from a righteousness point of view so concerned and focused on, we want to make sure the tenant has coverage for their personal property if they ever have a fire. Yes, that's important, but that's really on the tenant to worry about. As far as I'm concerned, that's a personal dilemma that they need to act dutifully and responsibly to protect their own interests. But no, this is about your interest in the property specifically the low to medium severity but very high frequency flavor of tenant negligence, accidental property damage losses, the kitchen fire. Someone is cooking something that maybe they should clean their stovetop before they start cooking it, or their kid throws a Barbie in the oven and they don't notice it until the house is on fire. You don't want that scenario, which is caused entirely by the tenant's accidental negligent destruction of the property, to turn into a claim on your insurance policy. One, you have to pay a deductible. That's the immediate pain. Two, having those losses over multiple instances leads to deterioration of profitability on your account from the insurer's point of view. You want to save your insurance coverage for those shock loss, building burning to the ground kind of scenarios. It's really the only practical thing that seems dutiful to claim in recent years. But you also don't want to pay out of pocket every time there's $80,000 to your property, damages caused by a tenant kitchen fire scenario. So that's where the requiring renter's insurance and or force placing equivalent coverage, tenant legal liability insurance, comes into play for you, because by requiring renter's insurance and or force placing tenant legal liability insurance, you're able to make that loss scenario a claim on someone else's insurance policy that is not rated against you. So it's not so much that you do this and you get a 10% credit on your insurance. No, it's not like a discount. It's you keep the most attractive on pricing but pickiest insurance companies in your wheelhouse and wanting to underwrite your account. Say yes, giving you insurance or selling you insurance by implementing such a risk transfer best practice within your operation. It stabilizes and maintains the stability of your insurance program. That way you don't have to then go and court a less attractively priced but less picky on the underwriting insurance company. So it's one of those things where it's unfortunately hard to say that it's working unless you have a crystal ball and can see what it would look like if you had done this. But I can tell you just from our practices, last winter, for example, almost exactly a year ago now, holiday season 2022, we had a shock freeze event throughout the upper Midwest. And, it got down to -15, -20 for the better part of a week. But a whole bunch of brilliant tenants decided, I'm going to save $7 on my electric bill next month. I'm going to turn my heat off while I go out of town to go see the family. And they come back and the plumbing in the walls has exploded. And you're looking at $70,000 worth of water damage to the property. Your property manager gets a call from the water company. They shut off the water, stop the bleeding. But by then, the damage has already been done. You're looking at either a decent chunk of money out of pocket or an insurance claim. Neither are good. You don't want to kick the insurance company bee's nest and tempt them with non-renewing you, because they're fishing for a reason to do that. Not because they hate multifamily or have any issue with you. It's that they literally do not have the capacity to take on all of the property heavy accounts that they have on the books because of where reinsurance markets are at. So if they're looking for an excuse to reduce their exposure to essentially property heavy risk that they don't have sufficient reinsurance capacity for, they're fighting for their AM Best rating right now. A lot of the same dilemmas that impacted the Silicon Valley Bank earlier this year in terms of where they were too bond heavy, and as bond valuations deteriorated, essentially their balance sheet went up in flames. It was inefficient risk management essentially by Silicon Valley Bank. They kind of did it to themselves to some extent. Well, insurance companies have a lot of the same exposure to the, way that bond valuations lead to deteriorated credit standing for the company. So essentially, the takeaway is you don't want to tempt fate and encourage or motivate or reward your insurance company for not renewing you unless you absolutely have to. That needs to be reserved for the shock losses in which you cannot sustain it out of pocket or otherwise make it a claim on someone else's policy and make it their their problem to worry about. Because I can tell you, after remarketing a 1,024 unit apartment complex in Michigan with about 3.2 in paid trailing losses over the last 5 years, they had one building burned to the ground Halloween 2020 and a smaller for $500,000 fire loss in late 2018. But that account had been with Greater New York Mutual. They're one of two companies in the Midwest that have capacity up to $1 billion total insurable value on admitted paper. We had to remarket that account. I thankfully was able to get a layered, non-admitted property program called SEBA to take the property, and then I essentially crammed the casualty insurance down a company called Westfield Insurance down their throat in binding authority. They probably wouldn't love or knowingly write a 1,024 unit apartment complex general liability and umbrella liability policy, but it fell within my authority and it was technically within their guidelines. Even if had I needed to speak with my underwriter, he probably wouldn't have said yes, but I didn't need to, so I just pushed the casualty through on that. But long story short, the expiring premium was like $385. We wrote it at $851, and the insured took it with a smile and a grin on his face because he understood, based on having lots of buddies who also own 1,000-unit apartment complexes and other large multifamily assets, if you can't get a SEBA or amalgamated or any of the other E&S multifamily products to, underwrite your account, then you have to do what's called a ground-up layered program arrangement, which is where you build out property insurance coverages the same way one might for general liability with an umbrella and then excess liability on top. You can do the same thing with property. And heaven forbid, if we had to do that, that client would have been looking at not a $851,000 renewal premium, but a 1.1 to 1.8 million renewal premium. So essentially the takeaway is you want the low to medium severity but very high frequency flavor of property losses to be someone else's problem.
Oh, enlightened investors, if you haven't done so already, be sure and click that like button and also click that share so others can take advantage of the content. And finally, be sure to subscribe so you don't miss a single one of our upcoming episodes. Well, that makes perfect sense. I'm wondering about a couple of things. If landlords could actually require tenants to have tenant insurance, or is that something that we can only just request and strongly suggest, or do we have a legal right to actually require it?
So I think it is state by state in some aspects. I know that in many states, specifically if it's any kind of like a subsidized, Section 8, Section 42, it gets really touchy with forcing renters insurance, the HO4 renters insurance policy form. But this is a legally distinct product written on a commercial general liability policy called tenant legal liability insurance. It's technically liability insurance for the tenant's liability interest in your property as it pertains to accidental property damage through their unintended negligent actions. So the famous insurance / CPA / any other professional services advisor disclaimer: talk with your attorney. I'm not a legal professional. This is speculation, and I'm not qualified to really say definitively. But my understanding is that in most, if not all, states, because it's technically not an HO4 renters insurance policy form, I believe that you are generally able to force place this coverage on the tenant's behalf at their expense. You are the policyholder. They extend additional insured protection to this tenant. It comes on a master policy. So it's one policy with numerous tenants, numerous units. And then you just bill it back to them the same way you might for the water bill or electricity or garbage disposal or anything along those lines, like a line item cost.
Well, here in North Carolina, we can't bill back utilities. So I'm wondering, might be challenging to do that insurance as well. Something I'll have to look into. Well, the other question in regards to that is sort of you have two policies on the same property. When it comes to making those claims, are insurance companies going to fight against that or try to push the responsibility onto the other insurer?
The way it works, if damages exceed the policy limit on the tenant legal liability program, because it's not written on a one policy for one property basis. It's a master policy format where you can cover all of the properties in your portfolio or as many properties as you desire to expand this program to offer coverage for. But because it's technically a special use case general liability policy, if the damages exceed that of the policy limit provided by tenant legal liability insurance, typically it becomes the one claim on your property insurance policy, and then your insurance company subrogates the loss against the tenant legal liability insurance policy. You can often, not always, but a good chunk of the time, depending on how your primary insurance company handles these scenarios, but often when their subrogation efforts turn successful, they get their money back from the other company. Often you will see the primary insurance company reimburse the deductible. I don't know if they necessarily have to. It probably depends on each company's policy language and or state regulatory dilemmas. But essentially, it shouldn't ever turn into a finger pointing or blame shifting, responsibility shifting dilemma, because they're unique, different policy forms. Whereas if you had two general liability policies, like a typical general liability policy, or two property insurance policies for a 12-unit building, that could trigger the other insurance clause or condition in those policies. But I've researched the product substantially over the last 5 years, and I've never come across anything that suggests that could be a concern or worry. So that was a good question.
Well, something to definitely be to pursue and to learn more about that. It's very interesting, Calvin. We'd like to know more about your company specifically and to learn how it is that we can get in touch with you.
Excellent. So Falcon is a boutique, holistic, national commercial insurance brokerage based in lovely downtown Ann Arbor, Michigan, home of the Michigan Wolverines. We're licensed in 45 states and Washington, D.C. I insure at this point a little under 30,000 apartments. That's like 27-ish thousand units. Active in 45 states. We're appointed with, 140 insurance companies. I involve the big national and regional players that seem to win on multifamily, evolve, scale, and scope in pretty much every market. The only places we aren't currently playing too actively are California and New York. I'll likely dip my toes into those markets next year sometime, but I don't know if I have enough sandy left in my skull to go too far into California insurance right now. It's like one half notch less painful than Florida. I have a team of 10. Our core practice and focus area is real estate with a special emphasis on multifamily. I love my big apartment complexes. I don't get scared by any scale or scope of apartment portfolio. We have some that are 30 units, some that are 500 unit portfolios. I have a couple in the upper 4-figure unit range. So there isn't really too much that I don't feel extremely confident in taking on and delivering best-in-class outcomes on with multifamily portfolios.
Well, thank you for sharing that with us. Before we go here, we're running out of time here, but tell us a little bit about merger and acquisition and the pre-acquisition insurance. Do you provide that? What exactly is it, and what all does that cover?
So for the mergers and acquisitions, like the private equity side of our focus areas, it really comes down to working with the buyer on an acquisition and ensuring that all of their interests, including the kind of less obvious or less present or prevalent concerns, are being touched on and considered. So for example, let's say you're buying a doctor's office. Maybe they have 7 locations with a team of 40 doctors, a medical services or human services company. they have professional liability insurance, medical malpractice insurance, but have they bought tail coverage so that when that policy cancels up to a period as specified by the tail coverage extension, your interest as the buyer of the property for the company is protected should a client or a patient 2 years from now who was just in the doctor's office last week before the acquisition bring suit against the company citing some material harm to them as a result of a doctor's supposed professional negligence in their handling. You want to make sure that sufficient insurance coverage exists for those kind of scenarios. So really, it's a value-add strategy that we employ of thinking outside the box on acquisitions, both on real estate and non-real estate investments.
Would you recommend purchasers of multifamily properties to look into pre-acquisition insurance?
I think it's a very good idea to, well before you actually put up a letter of intent, go into a contract on a property, put up a fully earned GMD and plausibly risk that money if it doesn't close. You need to be working with and talking with an insurance brokerage, even if it's not us, that is capable and knowledgeable in the multifamily space. Because, for example, this year, we have at this point, probably about 700 or 800 unique clients that we serve, and a number of them, at least occasionally, will consider properties in the Florida market. And Florida property sellers are reporting on their T12 insurance premiums that no longer exist. And typically, it's one, they're basing their valuations off of expiring 22 to 23 premiums, as they have for most of this year. And two, if you bought a property 12 years ago and your insurance broker isn't diligently increasing the insurance to value or coverage that we have per square foot of the building to keep it in line with the minimum standards imposed by the co-insurance provision, typically 80% insurance to value. So if your building costs $1 million to rebuild the way it exists today, you can insure that for 80%, $800,000, and completely avoid any co-insurance penalty hurdles. But if they aren't diligently increasing the coverage limits each year, they just kind of copy and paste the same applications that were sent in when you bought the property in 2014. Well, I find that many sellers have an insurance premium that is artificially below where the market is at. So if you're basing your underwriting off of what the seller is reporting their cost to be, it's kind of like if I was looking at renting an apartment, I went and talked to 10 people off the street. Hey, what do you pay for rent? $600. Well, what they're neglecting to mention is that they rent a 300 square foot closet in, maybe a lower income city where the rents are a lot lower. Whereas I live in downtown Ann Arbor where, so it's a really attractive place to live and our rents have risen considerably over the last 10 years. So it's wise to do your own due diligence and work with a PNC brokerage, really an external partner that can help prepare you for where the market is at the time of pre-acquisition. I provide napkin math-ish indications to my clients all of the time based on rate times exposure. Insurance pricing is more complicated than X times Y equals Z, but you can kind of average it and drill it down to X times Y equals Z. There's nuance that goes into how the base rate is determined or the premium charged for 100 in building coverage. But if you quote enough multifamily, you have a pretty good idea of where trends and averages seem to put the average base rates for property and liability insurance. For example, I had one client who they were looking at I think 106 or 112 unit complex in Arkansas, or Texarkana, Arkansas. Interesting city name. They told me that the seller is reporting a premium of I think like $55,000, and immediately I call shenanigans. I know where the market's at, and that there's two variables that one can change to decrease the premium: the rate or the exposure. The rate is unless you happen to find an exclusive program that no one else has access to and it's woefully underpriced and below where the market's at, which I'm not going to say it never happens. I found one market like that ever in 8 years, and it was temporary. Insurance companies tend to snip out pretty quickly when they're underpriced, well below where the market's at. Nobody wants to buy business. It's bad for them. It's bad for the consumer. It's bad for the broker. But the far more likely scenario is that the building values are woefully underreported, well below the minimum needed to avoid the insurance penalty. I see that situation far too regularly, unfortunately. So I indicate based on rate times exposure, rate for Texarkana, I think I had estimated between 65 and 90 cents per 100 in building coverage. It's about right for the North Texas, Southwest Arkansas markets. They have a fair bit of convective storm, catastrophic hail exposure. That seems to be what really gets them in the North Texas markets. But I indicate a rate of 65 to I think like 90, 95 cents per 100 in coverage. And then an exposure between like 110 and 130 a square foot insurance to value. And yet run a replacement cost estimate. I believe that to be reasonably close to the lower end of minimum insurance to value needed. With a little bit of wiggle room or margin for error built into my assumptions. I prefer to indicate a little bit high. That way, once it actually goes under contract, I'm not setting a inappropriate, incorrect expectation once the clients put up a fully earned EMD that they can't get back, only to find that I can't deliver on meeting approximately or beating my indicated values. But at that point, if you know the gross square footage, you know the unit count, the rate range is 60 to 90-ish cents per 100, and you can do a insurance value between maybe 100 even, and 130 a square foot. Low end, high end of range. You can do the same thing with liability insurance. Maybe you do $50 a door to $130 a door, just to, again, build in a fair bit of wiggle room or margin for error. Then you add the sum of those two numbers together. That gets you a low end and a high end projected, kind of guesstimated property insurance ballpark indication figure. So as long as you have a pretty good idea of where the base rates are at for each asset class in each market, I don't necessarily spitball these numbers, at least without chatting with some of my mentors who do have experience in those markets. But when I'm entering a new market, California, for example, I won't claim to be the expert in. I have very limited exposure to the California market. But the Midwest, the Sun Belt, most of the I-75, and really most states at this point, except for California, New York, and some of the least populous, Alaska, Hawaii, Wyoming. That's really the only states that are an expert at this point. But essentially, you need to be dialing in your insurance figures that you're underwriting to conservatively and in a close partnership with whichever retail property and casualty insurance professional you find to be knowledgeable and talented enough to work with you and your team. Because if you're just punching in a generic, $550 a door, $450 or $700 a door, it's kind of like pick a number out of the hat. So I like to have at least some kind of supporting math to work backwards from to get that cost per door. I know that that's important for pro forma underwriting, but just kind of arbitrarily picking a number doesn't take the nuances of the property that you're underwriting into account. Because of a 300-unit apartment complex where it's, an average of 400 square foot per apartment, that's going to be inherently cheaper to insure versus a 300-unit apartment complex with average 1,400 square foot per door. So you got to take those variables into account.
Well, Calvin, it's been a pleasure having you. A very informative conversation. I've learned a lot today, so thank you so much for being with us. And enlightened investors, thank you so much for being with us again today. I know you found our conversation as enlightening as I have. So please take a moment to like, share, and subscribe, and head over to Apple Podcasts and leave us a rating and a review. Until next time, live abundantly, And we'll see you in the next episode.
Enlightened investors, wait, don't go just yet. I just want to remind you about our recently launched webinar that you will not want to miss. If you're at all curious and would like to learn more about how real estate investing can diversify your investment portfolio, alleviate the anxiety associated with Wall Street swings, leverage your 401ks and IRAs to substantially increase the return on your investment, and do all of this with turnkey, hands-off, passive real estate investments, then you'll want to immediately go to steedtalker.com/webinar. In the webinar, we'll also address the common dubious investment schemes that you want to avoid. To access the webinar, go to steedtalker.com/webinar. I look forward to seeing you in the webinar.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.